Hello and namaskar viewers, I am Sanjeev Pandya welcoming you to this week's edition of the Tax Talk with Ajay. This is the weekly show, brings you all the latest and all the right information you need to know when it comes to taxes, your personal taxes or corporate taxes. If you're owner of the small business to mid-size to large size, this is the show gets you all the information. And why? Because the show is sponsored by SAI CPA Services, a complete full-fledged professional accounting firm with multiple locations in the state of New Jersey, but they can help you out no matter where you are in the country. They have been advising and they have been preparing tax returns for the taxpayers for many years, over 20 plus years, and they have experience and they believe in one thing: do your taxes right, and whatever the deductions that you are entitled to get, you must get. So that's why SAI CPA Services is the one that you need to contact, 908-380-6876, or visit their website, which is saicpaservices.com. With that note, I'd like to welcome Mr. Ajay Kumar, CPA and MBA with SAI CPA Services. Like I say, over 20 plus years experience when it comes to taxes. And also, they are the advisors, investment advisors. Where should you invest in order to save taxes? It's too late for this year, but you can definitely, see them, meet them sometime before the end of the year to save money on your next year's taxes. So there is a lot more that you can find out with SAI CPA Services. With that note, I'd like to welcome Mr. Ajay Kumar to the show. Sir, good to have you.
Absolutely, Sanjay. Thank you very much.
Right. You're very welcome. Research and development, R&D is one of those most exciting, areas that always intrigues me to find out what is R&D and how does R&D works. Pharmaceutical company, medical labs and everything, they have their R&D department. Now, how does research and development comes with taxes also? That's what we need to find out from Mr. Ajay. So Ajay, tell us, research and development, what does it have to do with your taxes?
Absolutely. I'm glad you asked. So government has lot of benefits when it comes to R&D. Government wants to promote R&D, and that's why there are certain special rules when it comes to R&D, certain benefits that you can claim by doing some R&D. A lot of IT consulting companies make a lot of new products. Pharma companies, as Sanjeev you rightly mentioned. So America is the land of opportunity, and you can do a lot of things. A lot of new products comes here because there is acceptance over here. There are benefits around it. So in today's episode, as you rightly said, Sanjeev, let's talk about R&D, tax credit, and R&D expense, or in general, benefits of doing R&D when it comes to taxes.
Correct. Okay, interesting. So let's start with R&D tax credits first.
Sure. So there are two different things, and let's make sure we help our viewers understand the difference between tax credit and tax expense. So if you make, let's say, $100 in your business, $100 of profit, and your taxes are $20. A tax credit means your $20 of tax liability will go down by that amount. If I say your tax credit is $5, now you need to pay $15. Tax credit means your tax liability will go down by that amount, dollar for dollar. On the other hand, tax expense means we will reduce your taxable income by that amount. Let's say if your taxable income is $100, and we say your tax credit is $5, then your tax is $15. If instead of tax credit, if this $5 is tax expense, then we'll say your income is not $100, is $95. Your taxable income goes down because now you have a tax expense and you owe $19 as opposed to $20. So when it comes to expense or credit, you are always better served by trying to maximize the credit in general as opposed to an expense.
All right. So this is in a theory, sounds wonderful. Obviously because you know it, because you've been, advising your clients on this matter. But now let's talk in the layman's language, all right?
Sure, absolutely.
And a question coming from me. Companies like Pfizer and Merck and Johnson & Johnson and Bristol Myers and companies like that, right? They come up with these medicines. For example, Pfizer came up with COVID vaccine and Moderna and everything. So they did a lot of research for that, and they came up with this and all these medicines before before FDA approves and goes into the market, there's a lot of R&D. So whatever R&D has been done, companies get credit for that expense if they spend millions, hundreds of millions of dollars. Do they get credit?
They absolutely do. Now think about it. Take an example. Before you create this medicine, this product, this solution, it takes years before you get there.
Yes.
It takes millions of dollars. Now, Pfizer is a big company, but let's take a simple example. One company trying to develop one medicine. In the first year, they invested $5 million. There is no money coming in. Revenue is zero. The medicine is not there yet. So how do you file your taxes? Do you show minus 5 million? Or next year, or the year after? It can take 2 years, 3 years, 4 years, depending on the situation. So instead of claiming all these 5 million every year as an expense and showing a net operating loss of 5 million, you can move these things on the balance sheet, put it as an asset that you can amortize once the medicine is in the market. So when the medicine comes in the market, in that year, suddenly you're making $100 million. Now, do you have to pay tax on $100 million? Or you have the right to claim all the expenses that you have incurred in creating that medicine.
Correct.
That's the concept here.
All right. Okay. So they do get credit for the R&D and everything. Now, who qualifies for R&D taxes that we talked about? Maybe the pharmaceutical companies and medical companies. Besides that,
technological company is very, very common.
Yes.
And we see a lot of IT consulting company, a lot of software development companies. A lot of these companies create a product and you don't really know if the product is going to be successful or not, or how many people are trying to do the exact same thing, same solution. There are a lot of softwares that are trying to make life easier. You can have the software to book the meeting on the calendar. You have the software to remind you about the email. You have the software to automatically generate the email. You have software application on your iPhone doing certain things. So all these applications, all these solutions takes a lot of expenses upfront before they start generating the money. So more than pharma, we see a lot of companies, IT consulting companies, IT product companies taking advantage of these R&D credits.
all right. So now, having said that, what kind of documents the company would have to give or save it as a proof for the federal government to claim those credits?
Well, the federal government, the IRS does not require you to submit any document along with the tax filing to claim the credit. The onus remains on you. IRS has 6 years after you file the taxes to go back and see if you filed it right or not. But you need to maintain proper record. You need to create proper folder, proper case for yourself, what product you are trying to develop, what problem the product is going to solve, how long it's going to take. Once you have designed, once you have decided that this is what I'm trying to do, this is a proven concept, then you can claim any expense related to that product, including the staff cost. The main cost that we see are the salaries, the payroll, because people are working on that product. Then you could have machinery, or you could have intangible assets. A lot of travel needs to be done. A lot of meetings are happening. All those costs are fair expenses. What's not claimed is land or depreciable asset. Meaning, let's say if you're trying to create a farming product and you had to buy a lot of land. The land by itself has a future value. You can resell it. That's why we wouldn't really include the land in your R&D expenses.
Okay, so now while you were describing these things, a question was coming to my mind is that IRS really don't need any documents to give tax credit. Okay, fine, I understand that. But the CPAs doing taxes for that firm, right? They would need to see some backup in order to have a credit claim on a tax return. And my next question is, what form do they need to file for the tax credit?
Absolutely, absolutely. Other than the CPAs, there are specialized companies doing only this form, tax credit form. The form you file with IRS is 6665 or form 3800 is typically what we use.
6765.
6765 is typically meant for the technological innovations R&D tax credit. In general, the form is 3800 that goes in your personal taxes. But there are specialized companies, a lot of CPAs do it. But there are specialized companies that do not do anything else except this tax credit. A lot of those companies will charge you flat fee, 5,000, 10,000, whatever the situation is. And a lot of those companies will say, whatever the tax saving you have, give us X percentage of the tax saving. So it's a big market. If you have not explored the tax credit situation, you owe it to yourself to look into it.
So that means those who are specializing filing in this form 67, 65, right? They would want to see all the records.
Absolutely.
Because
absolutely.
somebody's got to have a backup ready.
Well, their name, their company name is on the stake. So they will ask you a lot of questions, a lot of details, the payroll records, the overhead records. If you have the trademark around it, they will ask for a lot of information before they can help you decide how much credit you can claim. And at the end of this whole research, they typically give you a form of 67, 65, depending on which state you have. Most states allow the tax credit as well. Say New York, New Jersey, Delaware, they all allow the tax credit. So along with the federal form, this company, the company that you are hiring to create these forms, to go through your information, will also give you the state form. And these state forms or the federal forms is what you include with your business tax filing or the personal tax filing.
Is there a tax amount limit, tax credit amount limit, that how much can you claim for R&D, or is there a limit on the payroll taxes when it comes to R&D?
Well, that's a little bit tricky. So yes, there is a limit. You can claim up to $500,000. So it's a huge number. And the way they calculate is the first $250,000 must be used first against the Social Security portion of the employer portion of the payroll taxes. Then you use once you have used up the whole employer portion of the payroll taxes, when it comes to the Social Security amount, then you move to the Medicare amount. And then if you don't use it enough, then you move to the next quarter. So there's a computation around it. But the amount up to $500,000 you can claim in the R&D tax credit, which is typically is an offset to the payroll tax liability that you're paying.
All right, quickly, 1 minute before the break, so a couple of questions and a one-line answer. How far can you go back to claim R&D tax credits?
Well, R&D, that's a good thing, Sanjeevji. R&D tax credit can be retroactive, so you can go back to file this R&D tax credit. Typically, any open year, IRS allows you up to 3 years of tax amendment. You can go back 3 years and do the tax amendment. So that tells you can claim the R&D tax credit by going back up to 3 years.
Does it ever expire, R&D tax credit?
Well, they don't necessarily expire, but the government does not allow you to go back more than 3 years. If you have a situation, you can use it going forward.
Okay.
But not backward.
Not backward. Okay. And claiming R&D tax credit, does it really mean that, maybe IRS will audit that company? Not
necessarily. I mean, it's not as uncommon as a lot of people believes. A lot of companies uses the R&D tax credit. It's all fair. It's a legitimate claim. It does not create, unless you are making a mistake, unless you are not doing it right, which can happen with any sort of tax credit or any sort of tax expense. If you're not doing it right, you have the potential. But I mean, as long as you're doing it right, you have the right to it.
Okay, and the last question. Does the company need to be in a specific industry to claim the tax credit?
Not necessarily. The tax credit is not about industry. The tax credit is more about what you're trying to achieve, what problem you're trying to solve. It's a technological innovation. It could be pharma, it could be IT, it could be anything.
Anything. So far, it fits into R&D, research and development category. All right, Ajay, thank you. With that note, we're going to take a short break. When we come back, we're going to continue conversation on R&D, but this time it's going to be R&D expenses. That's coming up after these messages.
Did you know how many forms the IRS has? There are more than 500 forms that you can use from the IRS system. 67, 65, the R&D tax credit form is just one of them. So when it comes to taxes, there are so many things that you can take advantage of if you know what you're doing.
All right, so you say IRS has over 500 forms, tax forms, right?
Absolutely.
Just the IRS, not counting the state forms.
That's right. So there are 50 states in this country. 43 states have income tax. 7 states do not have income tax. Florida, Alaska. There are 7 states. So in 500 forms that we are talking about, we are talking about the IRS forms only. We are not talking about the 43 states. They have their own form system.
Alrighty.
So if you know what you are doing, you can save a lot of money.
All right, so your next week assignment is that to name all 500 tax forms, all right, now, with the numbers and everything. Anyway, I'm just kidding. Okay, all right, we're going to continue. In case if you have just joined us, today's topic is research and development. How does that apply in the tax forms for the companies when they engage themselves in the research and development activities? And earlier, before the break, we talked about R&D tax credits. Now we're going to talk about R&D expenses, tax, how much tax you need to pay. There's a section 174. Section 174 is a very significant section that is, that is about innovation and the advancement in the technology that government gives a benefit to those companies. Now, how that can be used for the tax expense or to even get a credit for tax expenses, that's what we're going to find out from Ajay.
Yeah, absolutely. So in the first segment, we are talking about that the R&D tax credit. In this segment, we will touch upon R&D tax expenses. So after the TCJA, Tax Cut and Jobs Act, R&D expenses are supposed to be going on the balance sheet, not on the P&L. What it means is you're not supposed to be claiming R&D expenses in the year they incurred. Meaning, if you're trying to develop a medicine or a software product, first year you spend $1 million, you don't claim it as an expense. Second year, you spend another $1 million. Don't claim it as an expense. Third year, you spend another $1 million. Now the product is ready. Once the product is in the market, once you start using the product, that's when you start amortizing this R&D expenses. And it's again for our viewers, it's good to know that if you are doing this R&D domestically in this country, government gives you more benefits as opposed to if this R&D is being done outside the country.
Okay, all right. So R&D in a country, right? Now, my question is that is amortization is the best option or can it be expensed also?
Well, it's not about what's best for the taxpayer. It's more about what's legally allowed by the government. So if you have an option for anything that you can claim as an expense immediately, from a tax perspective, you should go with that option. But there are certain things that the government wouldn't allow you to expense immediately. In those cases, you have to amortize it or you have to put it on the balance sheet. And once the usage starts, that's when you start amortizing.
And what's the life of that amortization expenses?
Well, that's tricky. It depends if it's a domestic R&D or an international R&D. So if it's a domestic R&D, you get 5 years. Meaning, if you spend, let's say, $10 million every year, you can amortize $2 million, 5 years. But the way the tax rules are written out, in the first year, you use the half-year method, meaning you don't really get the full benefit of $2 million if you started using the full year, just because we don't really know how much the usage was. You are saying that we started using in January, but initially the usage was lighter, and towards the end of the year, there were more users using it. So for the first year, IRS doesn't give you the full year benefit. You have to use the mid-year theory. So you get half. So if you have spent $10 million, instead of getting $2 million in the first year, you get $1 million in the first year. Then two, and then in the sixth year, you get $1 million.
Okay, so then put in a simple question. If an Apple spends money on R&D here in the USA, they get certain time frame for the credit. But if they spend money for R&D in India, because as you know, Apple has just put on a huge manufacturing plant and they've been manufacturing phones over there. So if they spend money on R&D in India, it's a different
right,
amortization.
Absolutely. So the principle remains same. Instead of 5 years, you have to amortize these expenses over 15 years now. Mm-hmm. So in the first year, let's say 6.6% is what you are expecting to amortize, but in the first year you only get half of it. So in the first year you get half, then you can get 6.6 for the next 14 years, and then in the very last year you will do again half. So you have to use the mid-year theory, the same principle, except for domestic R&D, the government is allowing 5 years amortization, and for the international R&D, they are allowing 15 years amortization.
Okay, very good. What is the criteria for qualifying for these expenses?
Well, it could be anything, as long as you have a proven concept, as long as you know the product is going to work, as long as you have more than one method of creating this product. So there are fixed criteria. You can't be saying, I don't know what I'm doing and hopefully something will work out. That doesn't count as R&D. R&D has to be for a proven concept, and you have more than one theories to prove the concept. Once you have come to a point that this is claimable, this is a specific thing, a specific product, a specific formula that you're trying to reach, then all the expenses related to that formula, product, can be claimed, including salary, including overhead, travel, whatever extra, including sometimes you want to get the trademark around it. All those expenses are fair expenses when it comes to R&D expenses. Again, what we don't like, what we don't allow, what the government doesn't allow is a depreciable asset. Let's say if you are buying a lot of computers to do the programming, then you have to use a different depreciation table for those type of assets. In that case, you can use section 179 for the depreciation that's allowed for the fixed asset, for the depreciable asset. If you have land, we don't like you to depreciate or amortize the land. Land stays separate.
Okay, all right, so that's a section 179. Earlier I talked about section 174. So what are the costs, can be capitalized under section 174?
Well, as we just discussed, anything that's related to that proven product, related to that proven concept, it could include the biggest cost that we see in this country is the salary, the payroll. Any overhead expense related to that payroll, including the payroll taxes, including the fringe benefit, including the 401k given to those employees. If you have a concept that you have that you're trying to take to the market, including the marketing cost, including the testing cost, is all fair as long as it's related to that proven concept, proven product.
All right, a little more than a minute to go in the show. Which entities are subjected to section 174 capitalization?
Well, all type of entities. There is no restriction. It could be right from Schedule C, a single member LLC, to C corporation, LLC, partnership, S corporation, C corporation. There is no such limitation on the type of entity you have. It's more about what are you trying to achieve. Is it achievable? And all those expenses related to that are fair R&D expenses.
Okay, and are all R&D expenses can be deducted under section 174, or there are some limitations?
Well, as we discussed, unless it's a depreciable asset, then you have to go through a separate section. Unless it's land, then you don't depreciate or amortize. Most expenses related to that concept can be put on the balance sheet and can be amortized.
Okay. Are there any certain states, they are conformity to section 174?
Well, there are some states. The good thing is in our area, New York, New Jersey, they accept the same rules as the government, even though the limits are different. New Jersey has a fixed limit of $25,000 maximum depreciation that they allow. But I mean, most states will conform to IRS, even though each state will have their own limits around it.
All right, this is very, very interesting. This R&D, the tax credits and tax expenses, this has been very, very educational conversation. And Ajay, I must compliment you for all the knowledge that you have and all the questions that you're able to answer. Viewers, I come up with the questions very impromptu, and Ajay knows that. So, but he answers each and every single question very correctly. That shows that how much knowledge and experience he has, and why SAI CPA Services is one of the most appreciated tax firms by our own community and the outside our community here in New Jersey with multiple locations. You need to contact them for all your tax matters and see that how satisfied you will be once you have taxes done by SAI CPA Services. Their phone number is 908-380-6876, saicpaservices.com. It's time for the quote of the day from Ajay Kumar.
Well, Sanjeevji, today's quote is, the tax system should look like as if somebody designed it on purpose. In our country, the tax system became so loosened. Every year we have a new rule, new exception to the rule that we made in the prior year, and it looks all over the place. We were just discussing 500 forms for IRS. So today's code, ladies and gentlemen, the tax system needs to look like as if somebody designed it on purpose, not something that just grew out of necessity.
Okay, interesting. Whether you like it or not, taxes do matter. And if you are living in the USA and if you're earning salary, making money, businesses, you must file your tax returns whether you like it or not. The question is, where do you go to file your tax returns right, exactly right, the way it should be done, so you can avoid audit and everything, and you can have all your deductions, whatever you're entitled for. You can go to SAI CPA Services. We thank SAI CPA Services for sponsoring the show, and I'd like to thank Mr. Ajay Kumar for advising and guiding us every week here in the show. I am Sanjeev Pandya. Remember, tax season is in the middle, so pull out all your documents and get your taxes done right. Until we meet again, same place, same time. You have a tax-free days ahead. So long.
Thank you.